Hi, my name is Marlo Peterson. I've been practicing as a CPA in California for over 30 years. Today, I'd like to talk to you about 3 truths that are often overlooked when analyzing investment results. You know, saving for retirement is much like a race, not like a sprint, but more like a marathon. In a marathon, you have markers, pace clocks, and directional signs along the way to make sure that you're going in the right direction and at the right pace to finish the race with the results that you expect. Let me ask you, what if the 5-mile marker was placed at the 4-mile point? Or a pace clock was not working? Or a directional sign was telling you to go the wrong way? Well, you'd quickly find yourself off pace or off course, and most likely would not finish the race with the results that you expected. Let me ask you another question. Does it seem like your retirement savings is not growing at the pace that it should be? Like a misplaced marker, a broken clock, or a sign telling you to go the wrong way, a misunderstood or unknown truth about your retirement savings could quickly throw you off pace or off direction and cause you to not achieve the results that you expect. The historic average rate of return for the S&P 500 is 9.15% for the last 10 calendar years, 6.77% for the last 15 calendar years, and 9.95% for the last 20 calendar years. If the annual rate is close to 10%, your investment should double every 7 years. If your investments double every 7 years, and you have 21 years until you retire, a $500,000 nest egg should be worth $4 million by the time retirement comes. You know, I've heard this 10% average rate of return for years, and for years I've been baffled by the investment results that I've seen on the tax returns I've prepared. For over 30 years I've had a front row seat to the investment results of hundreds of individuals. And except for a very few cases, I have not seen anywhere near a 10% annual rate of return. The fact is, it is easy to misunderstand what is meant by average rate of return. Also, there are costs associated with investing that are often overlooked. Today, I would like to shed some light on 3 truths that I've learned over the years that should be considered when evaluating investment results. The first truth is that an average rate of return is not the same as an actual rate of return. I want to illustrate this point with an example. Suppose I invest $1,000. In year 1 results in a 40% loss. At the end of the first year, I have $600 remaining. Year 2 is much better and results in a 50% gain, but at the end of year 2, I only have $900 remaining. Even though I've lost $100, 10% of my original investment, my average annual rate of return is a positive 5%, when in fact my actual rate of return is a negative 5%. You might be asking, well, how can this be? Is this guy playing some kind of trick with the numbers? Well, let's see if the results change if the order of the gain and loss are reversed. In year 1, I have a 50% gain, so at the end of year 1, I have $1,500. If year 2 results in a 40% loss, at the end of year 2, I still only have $900 remaining. It does not matter the order of the gain or loss, the result is the same. This means the actual rate of return will never be higher than the average rate of return. If we compare the average rates of return for the S&P 500 with its actual rates of return, we see that the rate of return for the last 10 calendar years has dropped to 7.29%. For the last 15 calendar years has dropped to 4.96%, and for the last 20 calendar years has dropped to 8.18%. We see that in the case of the S&P 500, the actual historic rate of return is approximately 1.8% lower than the average rate of return. The second truth is that fees are a necessary part of most investing. Fees are primarily associated with the direct and indirect management of investments by trained, educated professionals. Investment advisor fees are typically based on the value of the assets under their management. According to a 2014 Bloomberg report, An Investor's Guide to Fees and Expenses, advisor fees can range from under 0.75% for account holders with more than $10 million under management to over 1.5% for account holders with $100,000 or less under management. There are also fees associated with actively managed mutual funds. According to the same Bloomberg report, investors pay annual fees associated with actively managed mutual funds that average 0.89% of the fund value for equity funds and 0.65% of the fund value for bond funds. There are also fees associated with 401k plans. According to Brightscope, annual fees for 401k plans vary based on the value of the assets in the plan. Large plans with assets over $100 million usually have fees below 1%. The fees associated with smaller plans are typically between 1.5% and 2%. If we assume fees associated with investing average 1.5%, we should adjust our expected rate of return accordingly. After reducing actual returns by 1.5%, we are left with more realistic returns of 5.79% for the last 10 calendar years, 3.46% for the last 15 calendar years, and 6.68% for the last 20 calendar years. The third truth, and probably the most commonly overlooked, is income taxes. Unless you're investing in a tax-free or tax-deferred account, you're paying current income tax on the dividends, interest, and realized gains from your investment activity. In most cases, the investment advisor fees you're paying provide you with no tax benefit. Let me illustrate how income taxes come into play with an actual example from a tax return that I prepared during the 2015 filing season. My client's brokerage account had approximately $1,070,000 under management. For 2015, he received a 1099 from his brokerage account reporting total income of $73,056. The expenses associated with this account were advisor fees of $17,725, federal income tax of $16,603, and state income tax of $9,359. His total expenses were $43,687, leaving him with a net profit of $29,369. At first glance, it appears this client had a 6.84% return for 2015. His actual return was only 2.75% after taking into account advisor fees and income taxes. This client had a combined federal and state tax rate of 35.5%, but I will assume a lower combined federal and state tax rate of 25% for this illustration. After considering actual results, factoring in advisor fees and income taxes, we are left with much more realistic rates of 3.97% for the last 10 calendar years, 2.22% for the last 15 calendar years, and 4.64% for the last 20 calendar years. The truths that we've talked about today are not complicated. However, they're often overlooked. If you're not experiencing 8, 9, or 10% returns, don't feel bad because you're in the vast majority. As you can see, actual returns, especially after factoring in income taxes and fees, are far less than average returns and much more in line with what I've seen over the past 30 years. The current rates for 30-year municipal bonds are between 2.6 and 3.15%. Fees associated with investing in municipal bonds are lower, and if you invest in in-state municipal bonds, there's no income tax on the interest income. Municipal bonds are considered to have less risk than stocks. With low risk, we generally expect low returns. Stocks, on the other hand, have a higher potential for returns. However, we can see by our analysis that the historic returns for the S&P 500, especially after factoring in fees and income taxes, are not much more than the current bond rates. Let me ask you a question. If you could have the safety of high-grade bonds, share in the high potential growth of the stock market, and defer income taxes until withdrawal, or withdrawal tax-free, would that be something you'd be interested in? Well, if so, stay tuned, because in upcoming videos we're going to go over some options that will allow you to do just that. Thank you for watching.